Good afternoon, everybody. This is John Rothe over at Riverbend Investment Management. Welcome to our big picture weekly market update. This is going to be for the week of August 5th, 2024. So obviously a lot to digest today, a lot to talk about. This morning we woke up to the futures being down about 1,000 points, and markets opened up down big time. Right, we've been trading down about 1,000 points for most of the day here within the market. Nasdaq down about 500 points, so fairly impressive drops today. We're seeing across the board in all areas of the market. We've had a lot of different catalysts pushing the market down over the last week or two, and the big one seems to be really what happened last night. Japan raised rates, pushed the Nikkei, the Japanese market, down about 12%. So fairly impressive drop within the Japanese market, and that seems to really just be spreading out globally right now. I'll talk about some of the reasons why, but I kind of want to dive into some of these charts first. So we talked about last week how in our models we were starting to raise cash across the board because we were starting to see various sell signals arise in the market. There was just a lot of news that was coming out that seemed to increase volatility, increase some of the nervousness among investors. And we started to pick up in different areas of the market and some of the indicators we look at. And started really with the idea that President Biden wasn't going to seek re-election. We had a lot of mixed economic data. Investors were hoping the Fed was going to come out last week and say that they were definitely going to start cutting rates in September, but they gave us a bit of a mixed message saying that they're still waiting on some data here and they're kind of hemming and hawing, not really willing to make a decision one way or the other. Then Friday, we had some fairly weak economic data showing that the employment rate was starting to rise. So the big fear Friday was basically that the Fed had waited too long for this supposed soft landing that they were kind of trying to construct. And because they waited so long, that maybe we are going to fall into more of a deeper recession than anticipated. And that spooked the market quite a bit as well. So we talked about last week how we started to see some of these trends breaking down. We continue to see these trend lines break down. We saw weakness in momentum starting to come into play. If we look at the equal weight S&P 500, if you remember, the traditional S&P 500 is market capitalization, meaning the biggest percentage of share goes to the largest companies. And right now that is the technology sector, whereas equal weight gives everybody an individual vote. You don't have technology sector overweighting any other area of the market. And what we saw here, we started to see basically a bit of a breakout showing that maybe we were starting to see some markets that investors are starting to explore other areas outside of technology. And we started to rally to these previous highs and then got rejected, turned right back down. And during that time, we saw what's called a bearish divergence. This is when momentum is not increasing as the market starts to rise. So we saw basically weakness and strength here as the market was rising, showing us that there's some kind of internal weakness here. And these typically represent sell signals or some type of reversal in whatever area we're looking at. So in this case, we were expecting some type of reversal to come and play here within these equal weight ETFs. And it seems like that's what's starting to happen right now. If we look at the Dow is interesting. We had this long sideways trading pattern, and then it broke out, failed, broke out again, failed. And we're seeing weakness in momentum. And this is all before today's action. These are all charts as of the close of Friday here. So obviously we're much lower on these charts as well. We look at the tech heavy weighted triple Q. Again, before today's action, we had already broke through this trend line. We were trading below this cloud. We were down about 11-12% since those previous highs back in July. We had weakness in momentum coming back here. We had a sell signal here in our momentum indicators all the way back here. So just generalized weakness here as the market was drifting lower and lower, obviously nervous about something that was potentially waiting for some type of major catalyst to really push these markets lower. We look at the semiconductor index. Look at this, down about 24%. And again, this is before today's decline, down 24% since July 10th. So in less than a month, semiconductor stocks on average lost about 24%. So fairly severe sell-off here just in the semiconductor sector during this period of time. Now, if we look at our sector rotation graphs, again, we talked about this last week, how we were seeing weakness across the board as all these areas were selling off. Now, if you're not familiar with these give us a great visualization on where the momentum and strength are within the market. It's broken up into 4 quadrants with this area up here, this green quadrant being the strongest, and this area here being the weakest. And these typically rotate in a clockwise fashion here. And you can see for the last really this is showing us over the last 10 trading days here, this weakness that's been really coming into play here as all these areas get weaker and weaker and weaker in the market, indicating that we don't want to be in these areas of weakness here. And we're not really seeing any areas of strength. So as a result, cash is kind of king right now. Why not sidestep, wait out in a money market that's at least earning you some interest while waiting out for this market to kind of resolve itself and figure out, when the selling's done and people start to look for values. But right now, we just have been seeing continued weakness over the last few weeks within various areas of the broader market. If we look here at Apple stock, Apple was also big news over the weekend as Warren Buffett, in their disclosures, had mentioned that they had sold off about 50% of their Apple holdings. Apple was already under basically some impressive pressure. And again, this is before we even have a lot of today's news digested in there. But again, we can see it off about 17% since that July peak here, where we had that same peak in semiconductors. So tech stocks across the board have been fairly weak, as it seems like investors are maybe starting to shift away from these technology stocks. Now, going back to Japan, the reason Japan's having such a big impact globally is there's been going on what's been called a carry trade. And what a carry trade really refers to is investors are borrowing in a currency with low interest rates, for example, the Japanese yen, and then they reinvest these proceeds in higher yielding assets elsewhere. So the risky trade has been basically borrowing, across borrowing these low interest rates over in Japan and then investing in technology stocks here. So that is obviously starting to unwind because now borrowing costs are starting to rise. So all those portfolios need to be rebalanced. They need to be reallocated as they need to factor in higher borrowing costs. So this is why you see this kind of global sell-off within the market, because everyone is repositioning those portfolios for those higher borrowing costs. Now, just to show you what's going on in the Japanese market, this is why I'm not a fan of buy and hold investment strategies. As I said numerous times. If we can see here, this is the previous peak, December 1st, 1989. It took 34 years to break even, and now it is trading back down here. So if you're an investor in Japan, I'm sorry, but you waited 34 years just to break even, and now you are underwater again. So this is why I don't like these buy and hold strategies, because it's not something that happens in these third world countries. These developed markets can come down, and they can take a very, very long time to recover. And we've seen this kind of play out. A great textbook example here in the Japanese stock market of why these buy and hold strategies can be really detrimental to some of your longer term investment plans. But yeah, really having a hard time over here in Japanese investors have been really having a hard time with their markets. So what are we waiting for here? So going back to our relative rotation graphs, we like to wait for these things to start to move in the correct direction, which is leading towards strength here. So if you imagine here, we have this imaginary scale here, and we want to look for things that are moving in this direction. And right now, you can see nothing is even coming close to pointing in that direction. So we need to have some type of news come in here. It might be something that comes in rather quickly, where the Fed maybe makes a unexpected rate cut, and fuels this market much higher. Maybe the Fed is going to wait on data a little bit. Maybe they do want to push this market lower because some areas of the market have gone up so much, really since COVID, and maybe they want to push these markets down a little bit lower before doing some type of action. So there's a lot of things that are going on right now. We're going to have to wait for news over the next couple trading days to see if we get any indication that maybe the Fed is going to step in here, or if investors are just going to start to anticipate the Fed stepping in early, and we're going to have to wait to see. But I like to look at the data. I like to see that data start to show that that strength is coming into different areas of the market. Again, just because technology stocks like the Triple Q are so oversold over here doesn't necessarily mean they are going to be that leadership area. So we want to wait again to see what areas start to move up in this direction. And that might not be technology this time around. We might see value areas. We might see small cap areas. So it's worthwhile to not second guess, and worthwhile to just wait and see what the data shows us, which is exactly what we're going to be doing as we look forward to over the next few trading days and trading weeks. So that is it for this week, guys. If you have any questions, concerns, please feel free to reach out to me. Best way, as always, is by email at john.rothe@riverbendinvestments.com. Thanks so much, and we will chat next week. Bye-bye for now.